Hello, hello, hello. My name is Gavin. Welcome to M Trading's webinar. So another week, and we're going to go through some strategies today. So the specific topic today is the moving average crossover system. So I'm going to cover two specific systems. I'm going to cover a simplistic system, so a simple trading system that's based on two moving averages and it would give you buying and selling signals and how to use them. And then we're going to cover a little more detailed, complicated strategy which you could actually easily apply once you truly understand how to use it. Yep. But let's begin, guys. So I want to do a recap from last week. So last week we done a session on pivot point trading, and I've just come up to this chart and I have a perfect example for you guys if you have taken pivot point trades. So you can see how we have a significant downtrend taking place. This is WTI. So this is crude oil on a 30-minute time frame. So significant downtrend. It gets to the S1 level. So you can see how it respects the S1 level. So a very strong bearish candle or candles in this direction, testing the pivot point, the S1 level. Thereon, we have a candlestick formation that's taken place over here. So the blue candle, so we have a double candlestick pattern there. So what we have over there is a bearish candle that's gone something similar to this. And then we have the next candle that gaps lower, so it actually opens lower. It opens lower, moves above the previous candle high. Yep. So we can see that this candle here, so this candle that's been formed, as we can see, has engulfed the prior candle, which is an extremely bullish signal, a very strong bullish signal, which led to that movement higher. And where did it get up to? So you can see how perfectly if you'd entered on the next candle, which would be this point over here, so that will be your entry point. Your stop loss will be placed below this pivot point, the S1 level. Yep. And this drive went to your target level, which would have been within the next pivot point, which is your PP, so the pivot point itself. And that would have been your target. This would have been a perfect trade there. Yep. So that's how pivot points work really well, guys. For short-term day trading, a very good system to use. Not only did it hit target, it retraced slightly, so we had a couple of indecision candle formations taking place, and then we had the next bullish candle that's also broke through. So we potentially even have a breakthrough of a pivot point, which leads to another target, which is the R1. Yep. So that could be your next potential target. But okay, enough about that. About the pivot point system, we're going to cover a new trading system. So two specific ones, so a very simplistic moving average crossover system, and then we're going to go into something that's a bit more advanced. Yep. Okay, let's do this, guys. So what I'll do is I'll bring up a perfect example. The first key point I'll say about the moving average is that it defines strong trends. That's the key point there. So trend trading is perfect for moving average. Yep. So if you're looking to trade the trend, use a moving average system. That is perfect to find entry and closing positions as well. So where to take profits as well. Yep. So the way to use it is ideally use two moving averages. So use a fast moving average and a slow moving average. So what we have over here, this is our faster moving average, which is a 50-period simple moving average. And then we have a slower moving average, which is seen as a 200 simple moving average. Yep. So this level over here is taking 200 candlesticks and working out what is that average. It works out the average from this point to that point, being around this level here, and that is where it's going to stay. That is where the moving average is going to be at this price level. And then, for example, you have the faster moving average, the 50 period, is only going to consider this much information. So assuming that, or taking it from that point there, it's only going to consider this much information from there to there, and it's going to work out the average of that, which is up here at this point over here. So we can then therefore see that the faster reacting moving average, which is faster reacting most recent price action, is significantly greater momentum than the slower moving average, which leads us to believe that this is a potential buy signal. Okay, so that gives you a definition of how to use a faster and a slower moving average, but how do we use it? Let's go into that. Okay, the way to use it generally is, if I scroll through, let's move to a slightly higher time frame. So I'll go to a daily time frame. We're going to go to a daily time frame on the Dow Jones, so the US 30. And we're going to scroll back, so we'll zoom out slightly. And the idea is, what you're looking for is the crossover to take place. So we're always looking for a bullish crossover or a bearish crossover. So a perfect example is this point here. So we can see that, okay, price action originally was moving in this direction, and then the momentum started to weaken going in this direction. We started to break lower, so we started to break all these lows here. Yep. Price action breaks lower in this direction, which led to a lagging signal of this crossover. Remember, moving averages, it defines trends. Yep, so you can see where there is a strong trend, but the actual crossover takes place delayed. So there's a delayed reaction that takes place when you have the crossover of that significant trend. So this one over here is your crossover, which would have left an entry at this point here. So your entry would have been in this zone over here. Ideally, you keep your stop loss above those moving averages. You want to be above that crossover point in this area here. That is where your stop loss is. And your idea is to trail it, to trail your stop loss, move your stop loss as price action continues in your favor, or it may come back and hit your stop loss, then you're out of the market. Yep. So you wait for the next crossover signal. So as you can see, this continued lower. So we had this first initial pullback taking place, and then we had that significant sell-off. But all the way through, our red moving average, which is a 50-period moving average, stays below the blue moving average, which is your 200-period moving average. Yep, and that continues up till this point here. So that is the crossover point there, which would mean this is where you'd close the position. So at this candlestick formation is where you would take profit. So that's your take profit level. And out of the whole move itself, so taking the move from that high down to this low. So if we're taking the move from this high to this low, you would have captured the middle parts, which would have been this point here. So this would have been your profit point. Yep. So the idea is we're not looking to catch the tops or the bottoms. That's irrelevant to us. We're looking for strong defined trends, and we want to capture the middle part of it. This middle part that we're seeing over here from there to there is a higher probability setup. Whereas trying to catch these bottoms, trying to sell or buy at these levels, at the bottom here or at the top over there, those are much lower probability setups. So try this for yourself, guys. Go through this potential setup, applying applying the moving average crossover system using a 50 period and a 200 period. The idea is, in addition to that, you can stay in the market at all times. If the market is in very strong market cycle, trends with very good cyclical movement, you could be in the market at all times. So for example, as we just previously saw, that we would have closed the position in this area here, so the crossover was there, it will close in this region here. But in addition to that, you could close your position and also then look for a long, so look for a buy signal. So that would have been your entry for a buy signal. You would have trailed that all the way through, and the next crossover is at this point over here. Again, you would have crossed over somewhere at this point, and that is where you would take profit. Again, of this high from this low, so taking this low from that high, you would have captured the middle portion of this movement, which is your higher probability setup. Again, you're not looking for the tops or the bottoms of the markets, which are very low probability setup. Yep. And in some cases, the trend continues. So that's the idea of a trend. Yep. So there's a well-known adage, quotation that goes that always trade with the trend. The trend is your friend. So, for example, this would have been the perfect setup. So seeing that the market's come off at this point over here, so if I highlight this, so you have your original sell signal, you've had your sell signal at this point here, and it will retrace back and hit your stop loss. You would have been closed out at a full loss. Yep, doesn't matter, that happens. No one has a 100% hit rate. Your aim is to have a high probability setup so that you can have a better than 50% risk reward and a hit rate. Yep. So when we have the next initial crossover, which takes place in this area, so that's your initial crossover through. Yep. Your entry would have been at this point over here. Your stop loss, you could place it below the swing low, below the moving averages and below its previous swing low. So that would have been your stop loss, and this would have been your entry point. And this would have allowed you to stay in this market all the way through to this point over here. Only at this point, when it crosses through this level, you would have closed your entry at this point over here. So your take profit would have been at this level here. So now if we take the high and the low, so that is our high, and this is our low, we would have captured roughly about that much. So a significant portion of this movement. A significant portion of this movement. Yep. So let's do a recap on this. So the idea is you have two moving averages, one slow, one fast. You wait for the crossovers to take place and you enter that market at that point. Again, this system allows you to be in the market at all times. So you could be looking to go long, short at all times. You will never be out of the market. So the idea is make sure you trade with a major trend. In times when markets are moving sideways, as such, you would be whipsawed in and out. The moving average will be something similar to this. And you would have been in and out of this position multiple times, losing over and over again. So remember to look for market conditions that is not like this, but is moving in this direction consistently. So always look for a trendy market. This is where it works very well. Okay, so let's move on to the next more advanced process, the moving average system. Okay, so I've got an example right here. So this is a great system which allows you to better understand how to take advantage of short-term sentiments. It is for trend trades, and it also gives you very good breakout signals. So this is known as the Alligator System. Yep, so it's the Alligator System, not invented by myself. It was invented by a well-known technical analyst who's been in the markets for many years, for decades. His name is Bill Williams. And just going into your indicator list, if you go to Bill Williams, you have all his tools here. So what we're using here is the Alligator, and in addition to that, I'm using a secondary oscillator called the Awesome Oscillator. So let's do that on a specific asset. Excuse me, guys. Okay, so the idea is you have three moving averages. All three are simple moving averages, and all three are very fast moving averages. Some are faster than others. Yep. So what you have is looking at the parameters. So we're looking for a 13 period, 11 period, and an 8 period moving average. Yep. And so what we're looking for is significant trends, and the idea is we're looking for, if I zoom out slightly, we're looking for not scenarios that are like this, but we're looking for more trendy markets like that. Yep. So the idea is that when you have something like this, where the market is moving sideways, the moving average, all three moving average, will be intertwining with each other. Yep, so there is no separation between those moving averages. They'll be crossing over each other multiple times. That is when you stay away from the market. But when you have that impulsive breakout taking place, the market starts to trend, you'll start to see the moving average separate and form straight lines, for example, like this. When you have those three lines separated, facing in the same direction, that is your entry point. So you can take advantage of this somewhere in this area here. So if I now get rid of all of this, so assuming that this is more of a sideways market, so sideways market, sideways market, sideways market. Yep. So we've got an area of resistance. An area of resistance, and what takes place is we're seeing the moving averages intertwine. Yep, so none of them are facing the same direction. They're all crossing each other over. Right, and what takes place is we have the impulsive breakout. So the breakout takes place with this candle over here, and it starts to move higher. So it starts to move in a very bullish direction. All three levels by this point, so by this price action point, all three moving averages have separated and are moving side by side in a straight line. That is your entry point. Your entry point is through this level here. So that will be your entry point. Yep. And as this continues and as the trend becomes more intact and there's more momentum building up in this particular movement, you'll see the lines, the separation between the two lines widen as we continue in that direction, as you can see. There may be slight pullbacks, which are fine because that does take place. What you're waiting for is the next crossovers to take place. When you have the crossovers to take place, such as this area here, that is when you close the position. You close the position until you have another significant area of separation taking place with those three moving averages. So entering at this point, you would have closed your position somewhere in this area here. So you would have closed your position in this area, so taking profit there. You would have captured the bulk of this move. Yep, so you can see from that high down to this area low, you would have captured a significant amount of that profit. Yep. Right. Another example of that is the most recent price action. So you can see how this area here, so we can see prices going through this level. Yep, moving sideways, but what are the moving averages doing? They're intertwining. There is no significant separation, and they're not moving in the same direction either. Yep. So what they're doing is crossing over each other multiple times until we have the breakout, and the breakout takes place somewhere in this area here. So we can almost assume that this area here, which is the break of these two lows, the break of these two lows, that would be your entry point. So that would be your entry point. Yep. Stop loss, place the stop loss on the other side of this moving average, on the other side of all three moving averages. Right, and you would continue this until you see this taking place again, until you see this taking place again. The crossovers that take place with all three moving average. And would you still be in right now? For sure, guys. Yep, you would be in right now. Yep, this is still continuing that trend until you have the crossover. So right now you'd be in profit at this point, all the way down to that level there. By now, you should be moving your stop loss. So this stop loss should be moved down to this area here, so above this high potentially. Maybe you might be more aggressive and you're placing your moving average just above the red moving average, so the slowest moving average out of the three. So you could be in this area here as your stop loss is trailing. So that's stop loss 3, and that's stop loss 2, and that's your stop loss 1. So good trade management would allow you to maximize the profits and minimize your significant losses. And that is the process of the Alligator system. Now, using the awesome oscillator, so this is the awesome oscillator, this helps give you additional confirmation. So what you should be looking for is areas where it crosses below. So when it stays below, that shows you to continue to sell. So if it stays below, it's telling you to only look for sell signals. When it crosses above, it's looking for buy signals. But the larger, so the smaller these bumps are, so the smaller these hills are, these momentum moves that are taking place, there's not much significant volume taking place, and not much significant momentum behind that move. But when you see a significant sell-off at the lows and these highs, you know the market's trending. So look for a certain amount of drive that's taking place on the awesome indicator. Yep. So always look for buy signals above the zero level, and always look for sell signals below the zero level, and keep an eye out for divergence. So we have this low and we have this low, so this has made a lower low, but on the awesome oscillator, this low and that low, that is a higher low. So our awesome indicator is giving us an early warning signal that yes, there could be potential weakness in this move. So yes, we might see a new low forming, but on this the lines may start to do this, and as this starts to retrace and then break higher, that's when you start to see the horizontal lines above the zero level as such. So that might give you an early warning indication of a potential reversal. Yep. So be aware of divergence. Always look to buy above zero and sell below the zero level, and this will give you a good indication of that buying and selling pressure with the amount of movement that we see taking place from the zero level. Yep. So yes, use this in hand with the Alligator moving average system. It works really well. It's a very good system to use. And that's it for me, guys. This covers two moving average systems. One, a very simplistic system which allows you to be in the market at all times. Another system which is more advanced, using a secondary oscillator, which allows you to really time your entry points better. Yep. Okay, good luck with your trades, guys. Take care. Bye-bye.